Thank you, John, and let me thank each of you for being here today and for the interest that you have in our company. There are three topics that I would like to cover from a corporate banking standpoint that we think are absolutely critical to our success. You've heard some of these before, but it's critical for us. Number one is just a really strong risk management foundation. We believe that we have that, but we will continue to improve that along the way. And then our go-to-market strategy is critical for us as well. We think it's unique, and we'll take a little bit of a deeper dive into what that looks like for us. And then we'll talk, Jimmy, as I promised at the break, we'll talk about drivers of success and some of the investments that we will make in the business as we go forward. Before we get there, though, let's take a quick look at the overview of the corporate bank. We break this business, or our group, down into three businesses: commercial middle market that moves up to $250 million in sales. Bill Horton is here, and he runs that business for us. And then large corporate, which Ward Cheatham handles for us as well, picks up at that point. And also the specialized groups John Turner mentioned earlier sit in that particular category, and then real estate. If you look at the number of clients that these businesses manage, it's over 26,000. They manage $47 billion of deposits, $27 billion of loans, and that produces just under $2 billion of revenue. One of the things that we're very pleased with is how that mix has changed over the past 3-year period. When John Turner had this role a few years ago, in 2015, we set an aspirational goal that we would move non-interest revenue from 22% up to 28%, and I'm happy to put another green check mark on that one. We made that target in 2018, and we like where that trend is taking us on a go-forward basis. When you think about the foundation of risk management, it starts with client selectivity. You can't pick a bad client and structure them to become a good one. And so we are focused on those companies that have a reason to exist, well capitalized, proven ability to work through the cycle. And so client selectivity is critically important. But also important is really solid underwriting, rigorous monitoring, and then once we get those three things in line, where we really place our focus is on diversification. And we do that, Barb will talk about this just a little bit later, but we do that by having really strong concentration policies from an industry standpoint. And you can see that in this next slide on our commercial and industrial business. We start off with the most loan exposure, loan outstanding dollars in the government and the education area, and that represents 15%. Certainly not an outlier, but as you move down the list, we go all the way down to 1% from an agricultural exposure. But all of these industries are strongly supported by the industry and product experts that we talked about before. We get the best of both worlds there because we're leveraging up industry and product expertise with local bankers. We get local bankers, deep relationships, and they become very involved with our industry and product experts to bring about best-in-class client solutions. The group that has faced the most change, though, has been our investor real estate group. Many of you that I know in the room followed us when we put two banks together in the 06-07 category. And when we did, both banks had an outsized exposure to investor real estate. And not only were we outsized in the exposure, comparing that back to the total loan portfolio, we were out of balance from a product standpoint. Of all the slides that I will show you today, this is the one that is the most dramatic, and it's the one that I am so pleased with what the group has been able to accomplish since 2007. Look, they have positioned us to be in a very solid area. 7% of our loan balances compared to the top of company now reside in investor real estate compared to our peer group that's at 13%. This group has positioned us to grow, but don't make any mistake about it. Our growth in this category is focused on well-capitalized companies with proven ability to work through the cycle that all of you know is inevitable in this business. We're being very selective, but we did see growth in 2018, especially in the second half of the year. If you take a look backwards on the point-to-point growth in investor real estate, it was a 6% point-to-point growth, very healthy and focused on those kind of relationships that we're looking for from an investor real estate standpoint. This next topic is one that you're not aware of, I'm sure. We only hear about it every week. Some of you write articles about it. We get a question every week about this particular topic. Today's goal is to be as transparent about our leverage lending portfolio as we can possibly be. Barb will talk about some of the definitional standpoints and the differences and some of the inconsistencies that you have from one organization to the next. But I'll take a swing at what we are interested in from a marketing standpoint versus what we're not. Maybe it's easier for me to start with what we are not interested in. From a leverage standpoint, these are limited dollars for us because of the concentration limits that we talked about a little bit earlier. We are not interested in any leverage loan for the loan's sake only. This is not a transaction approach for us. This is a relationship approach for us. If we can't find the right client who is willing to provide us with opportunities for broader and deeper growth and moving in the right risk metrics, then we do not have interest there. There's good diversity, as you can see, if you'll notice in the bottom right-hand corner of this particular slide, you can see there's good diversification. Information and manufacturing both make up 17% of that, and you can walk your way down the rest of those categories because we're looking for diversification, but we're looking for opportunity for relationships moving in the right direction, willing to build something a little bit broader. If you also take a look at the left-hand side of the slide in the bottom left-hand corner, we have $1.5 billion of deposit balances on loan balances outstanding of $5.5 billion. 25% compensating balances in this business point to the importance of us and what we're doing by developing broader and deeper relationships. We love our go-to-market strategy. As a matter of fact, it starts with our client at the very center of what we do. Those clients, as John Turner said in his opening comments, face off against the businesses that we described just a few minutes ago. And those businesses are supported by industry and product experts. You can see on the right-hand side of the slide the product offerings that we have in our specialized vertical area, capital markets, treasury management, and our region's business capital group. We believe that we have the products that are needed to serve the markets that we serve today and to meet the needs of our clients. We believe in this because we get the best of both worlds. In many cases, our local RMs have relationships that have spanned over decades. And those are relationships that are valued by those particular clients. On the other hand, they may not have the industry and product experts that we have in these particular markets, and so they're able to call in resources to help them bring about the best-in-class client solution. And look, it's an efficient model for us as well. There's no way possible that we could take all of the industry and product experts and put them in the various markets that we're in today. Today, this group represents 10% of the headcount of our company. We produce 33% of the revenue and 40% of the profit. And what we haven't given up on is the service levels. You've heard both John and John talk about the service levels just a moment ago, and more than 12 times Greenwich has recognized us for having best in brand, best in service. And so we stay focused on that service, and it speaks to this model that we strongly believe in. When we successfully execute that partnership, you can see what happens on the left-hand side of this particular slide. You can see what happens to our RAROC models and also the percentage of revenue and profitability that the verticals are helping us drive. Diversification, again, is critically important to us in the right-hand bottom corner of this slide, and you can see where the vertical activity is taking place. So again, that partnership is the epitome of something that we refer to, and many of you know, as Regions 360. It's working across lines to bring about the best solutions that we can. Capital recycling has already been mentioned a couple of times today, and it's very important for us. We have capital that it takes to support lending activities. And yes, there are times that we lead from a loan standpoint. But when we cannot find our way to build a broader and deeper relationship, we make some of the tough decisions to move away from those relationships, and we provide ourselves with the opportunity to take the capital and redeploy it with relationships that make sense to us. In 2016, John Turner put in place something called the Capital Commitment Working Group. And it was a simple discipline. We meet once a week and we review all of our loans that have not been able to have a broader and deeper relationship. It's a manual process for us, but let me tell you what it does. It drives culture through our company in a very strong way. And you can see what's happened as a result of the focus that we're really giving this very important recycling approach. Economic capital, which is just a placeholder for how much capital that we assign to each loan based on how we view that risk, has been driven down by 110 basis points. And on the other side of that, our profitability continues to move up. And the reason it's moving up is not because we're getting higher price on our loan pricing, but because we're getting better opportunities to sell across the needs of those particular companies. We'll continue this process. It is part of our go-to-market strategy, and it's one that continues to prove that when we get capital deployed to the right relationship, it makes a big difference for us. You can't talk about our go-to-market strategy without mentioning our solid core markets. Markets like Mobile, Alabama, Montgomery, Alabama, Jackson, Mississippi, Shreveport, Louisiana. As a matter of fact, John mentioned this just a moment ago, but I had the opportunity in my career to spend more than 20 years in client-facing roles in these particular markets. What I can tell you firsthand is that not only do we believe in those relationships, those clients view us with great respect. As a matter of fact, in many cases, we represent for those clients the money center bank that delivers on a community bank basis. And the clients value that relationship. And in these particular markets, it's not necessarily where we bank. I know if you pull up some of the demographics, you'll find out that these are not the fastest growing markets that we have, but they are profitable markets for us. And the reason why is because the businesses that we bank in our core markets are not limited by city limits or state lines. I can't tell you the number of times in that 20-plus year period that I had the privilege of working in those areas that we saw our companies grow from just a city company to a statewide organization to a regional organization, and in some cases, having a national presence. And by the way, because of the loyalty that we have from those clients, we get to grow with them. 70% of our new revenue comes from existing relationships. Now, a lot of that is due to the fact that we are really focused on 360, but a good portion of that is because we get to grow with those companies that are in those markets that may not have the best demographics that you would look for, but those companies, once again, are moving past what those particular markets provide for them today. We do have really opportunities in our growth markets. We've identified 3 cities, Atlanta, Houston, and Orlando, that Bill and Scott and I are locking arms on over the next 3-year period. And we plan to have a synergistic approach in these particular markets. And you can tell why. Just take a look at several of the facts that you find below those particular cities. We already have some density there. Scott will talk about this a little bit later, but he'll be making investments in our branch delivery system, and Bill and I will be making investments in people and processes, and our plan is to attack those markets much like we do our core markets today. What we like about these markets, is that there's disruption in these markets, and we believe that our culture is a great place for people to come who are feeling disrupted by whatever may be going on in those particular areas. From a corporate bank perspective, we also make investments in other growth markets like Dallas and Nashville, Indianapolis and Charlotte. We are making opportunistic hires in those particular markets because of some of the disruption that's occurring there. And if you just look at our year-over-year comparison from 17 to 18, we had 7% revenue growth in these markets by making really individual hires with bankers who have great brands in those markets and enjoy the culture that Regions brings to the table. When I think about our growth strategies for the future, it starts with what we are known as a company, and that is a very strong deposit franchise. That's true for us also from a corporate bank perspective. 80% of our clients keep an operating account with us in the corporate bank today. And in 2018, we saw a 3% increase in our year-over-year growth in treasury management, cash management type products and services. That 3%, by the way, is on a very large base. But on our forward-focused strategies, and in several of the individual meetings I've had the privilege to attend with several of you, you understand that as rates have moved up, so have the client's appetite on what they expect from a liquidity standpoint. And we're responding to those needs. First of all, we're calling our coverage bankers to lead with deposits and our treasury management services. The reason that's important is because it's important to those clients today. Look, simply put, not every business has a loan need, but every business does have a deposit and a cash management need. And so if we're having those conversations, I promise, if they have a loan need, it comes up during those conversations. As rates have moved up, so have earnings credit rates, and it's given our customers the opportunity to have more buying power associated with treasury management products. And so we're also leading with those conversations. It's the right thing to do for the client, but it's also the right thing to do for us because it makes for a stickier client with every additional product and service that we're able to provide them along the way. And then we're also opening up more balance sheet opportunities to sweep excess balances to our balance sheet. We have a full array of off-balance sheet opportunities, but our clients tend to lean back into wanting to have that access on our balance sheet. We've seen really good traction in that process already, and we believe that that will continue to move forward. When we think about technology, data, and analytics and innovation, John Owen mentioned this earlier, John, in your comment about our end-to-end commercial lending process. Just about 8 months ago, we developed a team from across our company to take a look at something that we felt like had been in place for quite some time to see if there were more efficiencies. We set that team up in a Lean Six Sigma approach, and what we found is that over the years, we had created redundancies in our commercial lending approval process. Just by taking out the redundancies, and oh, by the way, before I go any further, the non-negotiable there is that we could not give up any credit quality standards that we had put in place. But what we did give up were redundancies that had developed within that particular approval process, and we have moved it, John, from 9 down to 3 days. It takes the transactions off the street. It eliminates some of the competition we have. It gives us a higher pull-through rate that our clients enjoy, and it makes banking easier for them. We are investing, as John said just a bit earlier, in several of our different platforms. Capital markets, commercial lending, equipment finance, and treasury management have either all had new platforms installed over the past year or enhanced platforms that we continue to work on today. In the third block on this particular slide are three things that I'm very excited about. Two of these are really tied at the hip, and it's the first two. One is an early warning risk indicator, and the other is a share of wallet platform. They actually work on the same platform. You remember the 80% operating accounts that I talked about just a moment ago? These platforms actually extract information out of the cash flows that are occurring within those operating accounts. With the help of outside vendors, we have identified more than 200 data points that we'll be able to pull information out of what's occurring within the cash flows within the operating accounts. That's going to arm our RMs with being much more proactive with our clients than being reactive. Not only proactive about potential risk that we see developing with that business, but also anticipating needs that the client has and having proactive conversations with them as we move forward. And then the last thing on the list, or at least in this third box, is something that we're referring to as a customer portal. It will create a repository of information where we supply industry information that we have about that business. The business does that as well, and it allows us to both pull closer and take a look at the business through each other's eyes. There's much more to come with the customer portal, and so we'll talk about a little bit later as we develop more, but having real-time communication with our clients is absolutely critical in the speed of the world that we live in today. In addition to those things that are so important to us, liquidity management and technology, we ask our teams in our 3-year strategic planning process to help us develop where we should go together. What I like about this is that it was a grassroots level where we went to our client-facing RMs and our second line of defense, and it became a team effort. It's an odd number, I know that. It's 11, but it's 11 really good initiatives that were developed by our teams. It ranges from everything from our commercial group and treasury management group that's focused on deeper penetration into our commercial card and the liquidity management that we're talking about a little bit earlier. Our large corporate group will continue to expand verticals. Certainly would move into the areas where we have growth opportunities along the way. And then we will, from a vertical standpoint, we will expand those verticals to include new opportunities. And within our real estate group, we're expanding our fund sponsor coverage. We're doing a great job doing the projects that we were finding in those fund sponsor coverages. But what we have found by developing a team, and we did that in late fourth quarter, we've already seen great traction of non-interest revenue opportunities that we're finding at more of the parent companies along the way. These groups work really hand in hand with our capital markets group. Several of you remember a few years ago when we divested our broker-dealer that we started rebuilding our capital markets team so that we could support our client base just with the needs that they have along the way. And those needs have continued to grow, as well as our capital markets team has been able to grow. And it's been a great positive story. Terry Caton is here with us today, and he heads that capital markets team for us. I've asked Terry to make a few comments about this slide, which is a dramatic opportunity for us over the last several years, and Terry, where we will go as we move forward.
Thanks, Ronnie, and thanks for everyone here for spending time with us. Wanted to talk a little bit about the growth we've had in capital markets. You can see over the last 4 years, we've been able to grow the business more than 175%. It's been a compound average growth rate of about 29% during that time. A good portion of this was, as Ronnie mentioned, in 2012 we sold our broker-dealer, and that gave us the opportunity to really take a fresh look at the businesses we want to be in, and we have a clean slate to work with. And so in 2013, we established a new broker-dealer called Region Securities and oriented the services we were going to offer to our clients to what we saw them needing in the marketplace. You see as well here some additional products we've added over the last 5 years. What I would orient you to is we're in three product groups. One is hedging services, and this is foreign exchange, interest rates, and commodities, where we help our clients manage the risks in their business. Then we have capital raising businesses across the public and private markets to support our corporate, commercial, and real estate clients. And then we've got advisory services, which is primarily our Black Arch M&A platform. You see here, as I mentioned, a number of our product additions. One I might highlight, in 2014, we acquired a Fannie Mae DUS capability that we actually rolled out to our customers in 2015. Barb is going to talk about how we've managed our multifamily exposure in this cycle. But this is a good example where we have a capability there that has enabled us to better manage the risk in that portfolio while creating better returns through more fee income on a smaller portfolio. So real success there. What we found, and this is a good example of it, the Fannie Mae DUS product, is our customers have really reacted well as we've brought out new offerings to them. The way we do business with them has really been rewarded from them, and we've grown the business, as you can see, substantially, and we've got additional opportunity to do that. The last thing I would mention to you, though, is we are not, you'll see Ronnie mentioned sales and trading on the loan side is something that we are building out, but we don't trade for profit. We will trade to enable our clients on the investor side to generate better liquidity in their portfolios, but most of our trading activity is to manage the risk in our customer transactions. And so you won't see the kind of volatility in our capital markets P&L that some of our peers exhibit. Thanks, Ronnie.
Yeah, thank you, Terry. And when we get these things in alignment, liquidity management, data analytics, technology, and the initiatives that we talked about, it really will drive continued efficiency for us. In 2018, our efficiency ratio was just over 47%, and we feel like we'll have more improvement with that over the next 3 years and beyond in the 300 basis point range. And so we look forward to continuing to focus on how do we get more efficient, how do we grow revenue, and continue to be really good from an expense management standpoint. I'll sum up today where I started. Number one, we clearly understand the importance of strong risk management. We have to do that to afford the right to grow every day. And we owe it to you as our investors to be solid risk managers. The second thing is our go-to-market strategy is something that we believe deeply in. We think it sets us apart in the industry. We think of it as our secret sauce. And those partnerships really do allow us to build deep, long relationships that we enjoy. And then last, on all the things that I mentioned about healthy growth, we understand that there will be economic changes, but we believe that these 11 initiatives really provide us with a solid pathway for continued improvement as we move forward. Thanks again for your time today. It's my privilege to introduce my partner, Scott Peters, who heads up our consumer group, and just a great partner for us on the corporate banking side. Scott.